Hi, so very good evening to all of y'all. Today, what we'll be looking at is a concept called as sale and leaseback, right? Which is tested under your standard, which is IFRS 16 leases. Okay, don't worry, it's a very tiny, small concept that you all need to know. In terms of ACCA skills paper, FR, you all will be tested. It could be either tested under section A and B as an MCQ or MTQ, or there is a chance that it would be tested in your section C as well. Okay, so let us directly jump into our today's concept of sales and leaseback. In terms of sales and leaseback, what you all need to know is why do we do a sale and leaseback and what is the accounting treatment if there is a sale and leaseback. Right? These are the only two concepts that you all need to know. That is why initially I told it is a very small concept. Okay. So first of all, let us try to understand. I hope my screen is visible. Let us try to understand why do we do a sale and leaseback. See, normally you all might be knowing that there are large companies, the PLCs, there are SMEs, small medium scale businesses, right? They do not hold larger amount of funds. They do not hold a larger amount of cash. Okay, they'll only have sufficient amount of cash. Okay, so in case if they have the necessity, if they have the need for additional cash to run out their day-to-day operations, what they would do is they might be having company assets, right? It could be the company land and building, it could be the company vehicle, it could be the company fixed asset, fixed plant and machinery, right? So what they would tend to do is, since they need cash to run their day-to-day operations, what they will do is they will start selling off their company assets, right? They will sell off the company assets to another third party, right? Under one condition. Under one condition. Can you see here? The person who's buying my asset, the person who's buying the company asset, should lease it back to us itself, right? That is what the concept of sale and lease back means, right? Don't worry, I have done an illustration and I'm planning on explaining it in a bit so that you all could even more have a comprehensive, detailed understanding. Okay, so look at this example for a minute, right? As you all could see, there are two companies involved, that is company A and company B respectively. Okay, what is happening here is company A is trying to sell his company building to company B, right? Company A is selling his building to company B. Okay, after that, under a particular condition, I told, right, there is a condition. What company B has to do is, as soon as the ownership of the building is transferred to company B, company B has to lease it back to company A, right? That is the condition, right? So you all might be knowing, when company A is selling the building to company B, obviously company A is referred as seller and company B is referred as buyer, right? After the sale is done, after the ownership is transferred to company B, right? There is a certain condition. I told you. Company B, as soon as he buys the asset, he has to, can you see here? He has to lease it back to company A, right? As soon as he leases it back, company B will be referred as lessor, right? Since it's a lease transaction, company B will be known as lessor or the owner. And since company A is using it for a certain period of time, which I'm not mentioned here, he'll be known as lessee, right? This is the concept in terms of sale and leaseback. What you'll do is, first, you'll be selling off your asset to a third party under a condition. Number two, the third party will be leasing it back. Can you all see here? The third party will be leasing it back to you. All right. And after it, you all will be termed as lessee and lessor from each company's perspective. All right. I was able to grab a slight picture as well from the internet. Just look at it for a minute and try to understand it if it's possible, right? Can you see here? A company is selling its asset, right? And after that, under a condition that they will lease it out, right? So once the purchaser leases it out, he will be known as the lessor, and the initial seller who sold the building initially will be known as the lessee. The reason being is because he is planning on using the leased asset, right? This is the simple concept of sale and a leaseback. You will sell it, and after that, you will lease it back from the same third party that you sold the asset for. Okay. Now, you all might be thinking, how do we do accounting treatment? It's quite simple. First of all, we need to understand. I told you all, right? It's a sale. Now, when a transaction has a sale, you all need to recall. You all need to recall a concept called as IFRS 15, which is revenue. You all know, right? Normally, any transaction cannot be considered as a sale as long as it meets the sales relevant conditions, right? That same principle we are planning on applying it here as well. Okay. First of all, step number one, in terms of accounting treatment of sale and leaseback, we need to identify, is this sale real? Is this sale an actual sale? Is this sale adhering to IFRS 15 standard? Can you see here? I've drawn a T diagram. If it's yes, obviously we need to consider it as a sale. Obviously, right? If it satisfies IFRS 15, all the conditions, then it is deemed to be a sale, right? If it does not satisfy, then obviously it is not a sale. Then what do we consider? What do we consider? We can consider that particular cash inflow as mortgage or a loan, right? And the double entry for that would be, you're getting cash, which would be bank debit. And after that, I told you all that it's not a sale. So the credit entry would not be sale. Instead, the credit entry would be termed as financial liability. Simply consider it as you all are obtaining a loan, right? So debit bank, credit financial liability. Okay. And another point that you all need to remember is when you all are obtaining a loan, right? Obviously, each and every month or each and every quarter, you all need to pay interest. Yeah, you all need to pay interest on the loan or the mortgage, right? So those will fall under financial expenses. Financial expenses, right? Those will fall under financial expenses in your statement of profit or loss. Now, this part on the left side, it's a very easiest one, right? I would not bother you all with, I would not even tend to bother with that particular part. Why? Because it will be tested in a limited manner, right? It is rarely tested, I would say. But this fellow on your left hand side, there is a high chance that it could be tested in either section A, section B, section C, right? So now we are going to look how are we going to do the accounting treatment if your sale is a real-time sale related transaction, right? So we have done a sale and it meets IFRS 15 conditions. So therefore, we are considering it as a sale. So now, as you all see, I have broken down the accounting treatment into two separate parts. One part is a sale and the other part is a lease transaction. Okay, so let us look at it one by one. Okay. Okay. As the concept says, it's two different concepts. One is a sale, and after that, you will be leasing it back, right? So we have found out on the left hand side that this particular transaction is a sale, right? So obviously when it's a sale transaction, debit bank, and you will be crediting the asset. The reason why you're crediting an asset is because you are selling off the asset, right? So when you sell off the asset, that asset needs to be removed off from your statement of financial position. In simple terms, you have to de-recognize the asset, right? So debit bank, credit asset. Now, for some people, they might be asking, why cannot we go and show this as credit sale? Well, obviously, you'll need to check your basics. Sale is only if you sell goods. In this particular scenario or the standard, we are selling our assets. So when you sell off your asset, it is debit bank and you will be crediting off your financial asset. Why? Because that asset is being sold, right? And obviously you all be selling the asset for a gain, right? Most of the companies, they tend to sell off their assets for a gain. And rarely there might be chances when you sell it for a loss. It depends on the question, right? That is number one. Number two, you'll be selling it to the third party, right? Once you're selling it to the third party, you will draw a clause. The clause says that once you're selling it to the third party has to lease it back to you itself, right? So then what happens is you need to do lease accounting. You need to do lease accounting. And the double entry for lease accounting is very easy, right? Simply, you need to debit right of use of asset and you need to credit something called as your lease liability, right? This will be done from the perspective of lessee. Okay, just give me a minute. This is done by the lessee, right? From his perspective. Why? Because he is only planning on using the asset, right? He is only planning on using the asset, right? So that is why you need to debit or the right of use of asset. And since this is a transaction that is related to lease, it will create a lease liability, right? So you need to create the lease liability. So in terms of sales and leaseback, if it's a legitimate sale, if it's an actual sale, what you all need to know is that sale will have 5 double entries. It will be having 5 entries, right? 3 entries for your actual sale and 2 entries for your lease. Simple as that. Okay. If you all have understood this particular concept, let me give you all a minute, right? So that you all could grab on. And if you all have not understood, we have 2 questions that's coming up where we could look and try to solve them and understand it in a most better manner through figures. Okay, just take about a minute and let me enlarge this so that you all grab in. Right. Let me know if my screen is visible. Right. First of all, I have written off a question. Right. I have written off a question, because I was able to grab it. You all need to read this for a minute or 30 seconds. Try to read this question for a minute. Company A sold a building, right? And then leased it back by company A itself, right? Company A would have sold a building to company C, and after that, he leased it back from company C itself. In this particular question, company A is termed as lessee and company C is termed as lessor. Okay. So here we need to do lessee accounting. Here we need to do lessee accounting. Now we need to find out, we need to follow off these steps that we learned. We need to follow off these steps that we learned. The sale took place, right? The sale took place, we sold it off, but we need to identify whether that particular sale is in line, is in par with IFRS 15, right? Normally this will be mentioned or a clue will be given, right? Here, see. The sale adheres to IFRS 15 standard. That means, what does it mean? It means that the sale is a real time sale, right? So we need to follow this particular accounting treatment instead of this, right? Instead of this. So it's simple. Just you need to match off the figures. Okay. We need to match off the figures. First of all, they have given us some additional information as well. They have given us some additional information as well. The carrying value of the asset is 80,000. The amount that was received, or the fair value, or the market value, or the cash value that was received was 100,000. And in addition to that, the present value of lease payments is 60,000. Right now, you all would have gone through the concepts of leases, so I don't need to mention what is present value of lease payments, but let me give you all a small hint as well. See, we would have taken that asset for about 5 years, 10 years of lease period, right? So what we'll do is we'll find out today's value of those 10-year lease period, today's value of those 5-year lease period, today's value of those 3 years lease period, right? And we have found out that the present value of our future lease payments, right, of our future lease payments is 60,000. Now it's all about simply filling in the blanks. It's all about simply filling in the blanks. I told her, right, when it's a sale and lease back, break the transaction into two different parts. One is related to sale and the other one is related to lease, right? We know that we have received, or the sales proceeds, or the fair value is 100,000. So debit bank by 100,000, right? Debit the bank by 100,000. And number two, this is not an ordinary sale. This sale is related to sale of an asset. Sale of an asset. So what do we need to do is we need to de-recognize that asset. We need to de-recognize that asset or remove that asset from your statement of financial position. Okay. So you all know on that date of sale, the carrying value or the book value of the asset is 80,000. So credit financial asset of 80,000. Now you all might be thinking, 100,000 is a sale, 80,000 is a carrying value. The profit should have been 20,000. Well, no. In this particular type of question, right? In this particular type of question, we will adjust, or we will find out whether it's a profit or a loss using the balancing figure, using something called as the balancing figure. Just give me about 3 minutes. I'll be explaining how do we arrive at this balancing figure. It's quite simple. Okay. For now, let us leave this profit part, the credit entry of profit part of that sale, and let us go into the lease accounting. Let us go into the lease accounting. As I told you all, we sold off the asset to a third party, and after it, under a certain condition, he'll be leasing it back to us, right? So debit right of use of asset. Obviously, you all know why it's a right of use of asset, because we are the lessee. What does the lessee do? He uses the asset by paying a certain amount of consideration or a certain amount of lease payment or rental payment to the third party, right? Now, how did I arrive at this 48,000? I will tell you all now itself, right? There is a formula that is given in your ACCA study hub, in your Kaplan study text. You all need to remember that. You all need to remember that. Just give me a minute. Yes, it. This is the formula. See, now this formula will not be given in your exams, right? So what I want you all to do is, rather than memorizing it, understand it, right? So if you all need to find out the right of use of asset, you all need to simply follow off this formula, which is carrying value of the asset into the percentage of rights retained. Retained means after the lessee will be leasing it back, right? The amount of this one, the amount of percentage that was obtained to the lessee. right? Now you all might be thinking, how do I arrive at this certain figure? You all might be thinking, right? Because the examiner has already given us sufficient information. We know the carrying value of the asset. We don't know how do we find out the percentage of rights obtained by the lessee, right? They have given us another equation as well. If you all need to find out, if you all need to find out the percentage of rights retained, you all need to follow this. Right retained are simply the present value of the lease payment, which is 60,000, right? Divided by the total rights, which is the total sales proceeds, the fair value. Can you see here? 60,000 was your lease pay. Let me write it out. Let me write it as well. 60,000 is your present value of lease payments, right? And the total rights was 100,000, right? So the percentage of rights retained would be, give me a minute, let me open up my calculator as well. That's about 60,000 divided by 100,000, which is your total rights of fair value. It's about 0.6. It's about 0.6, right? So it's simply 0.6 into your carrying value of the asset, which has been given 80,000, right? So that would be 0.6 into 80,000 would give you the right of use of asset worth of 48,000, right? It will give you right of use of asset worth of 48,000. It's simply that you all need to follow these two equations. Remember, the top part would be the present value of lease payments. The down part would be your total amount of cash that you have received, right? So what this means is, what this percentage of right retained means is, out of 100,000 that you received, right? That 100,000 that you received through sale, 60,000 you will be paying back. 60,000 you will be paying back, or you will be retaining it for using the asset, using the lease asset, right? So that's how we came up with 48,000. And we'll be crediting off lease liability with the present value of lease payment. Now, this you all have learned in your previous recording of how do you all record or how do you all do lease accounting, right? 60,000 would be your lease liability. Debit ROU, credit lease liability. I would give you all a hint. Normally in the exams, they would not give you right of use of asset, right? The remaining entire information that is related to the question will be given, right? The best part is finding of ROU, and for that you all need to learn the equation, right? Don't worry, we have another question coming up. We'll be looking at that as well. Now, finally, I hope you all remember when I started off this question, I told you all that there is a profit, right? Which is the balancing figure. Look at these transactions. There are two debit entries and there are three credit entries. There are two debit entries, which is the bank and which is the right of use of asset. And there are three credit entries, right? So what I would do is I would just simply add my debit sides and credit side and see whether there is a difference, right? Debit bank 100,000, debit ROU 148,000, which is equivalent to 148,000. So my debit side is 148,000, right? On the credit side, we have three entries. One is my financial asset, derecognition of 80,000. Number two is my credit lease liability of 60,000, right? Now I'm comparing. My debit side is 148,000. My credit side is 140,000. So I see my credit side is understated. You all can see I see my debit side is 148,000 and my credit side is understated by 8,000, right? So that 8,000 figure will be put under the credit side, and you all know profit is always recorded on your credit side, right? So this is how I arrived at the balancing figure and found out whether the transaction was a profit or a loss. Okay, so let me repeat this entire thing again in a simple form. For you all to do this transaction, you all just simply need to break it off into two categories. One, you all need to do a sale which has three double entries, and number two, you all need to do lease accounting which has two double entries. I'm 100% pretty much sure that you all will be having a problem with the lease accounting in terms of right of use asset, right? If you all know this particular formula, you all will be able to do it, right? That is problem number one. Problem number two. Problem number two. When you all are doing the sale, you all will come up with a profit, right? And most of the students tend to do is what they tend to do is that profit, they will not take the balancing figure, right? They just simply from the cash that is received, and they'll compare it with the carrying amount, and they'll just take it as that is given. Okay, so if you all have understood and if you all have done the very first question, you all can pause and try to pause this recording and try to do this second question. Now, let me be honest with this. I got this question from your Kaplan study text. Okay, so take about a minute and you all could read, pause the recording and you all could read, right? Let me see what's the requirement first of all. Explain how you will account for this transaction on 1st January 2004. Okay, so there's a person called Blank and he has sold his equipment to a person called Fume, right? For a selling price of 1 million. Fair value is something called as selling price on 1st January 2004. Fine. The carrying value is 800,000 of the equipment that was sold. Okay. Okay. And after this sale represents and also it satisfies IFRS 15 revenue. Now you all know again I'm doing this now. For the people who understand, there is no problem. For the people who are still trying to grab off this concept, right? What happened was they have done a sale, right? A sale of office equipment to a third party, right? And since the sale satisfies IFRS 15, right? You need to follow this method of accounting. Okay. This method of accounting. Okay. Blanco enters into a lease contract, right? I told you, you sell it under a condition of you again leasing it back, right? So Blanco enters into a lease contract. He sold the office equipment and after he's planning on leasing it back, right? With Fume for the right to use the equipment for the next 4 years. So the lease period is 4 years. Okay. Okay. Annual payments of 200 are due to at the end of each year. So you have to make 200,000 each year. The interest rate implicit in the lease is 9%. Okay. Now what they try to do, why they have given you this particular information of 200,000 for 4 years at 9% is for you to find out the present value. But normally in most of the questions, you all don't need to find out the present value of lease payments. The reason being, it will be majorly or majority of the times it will be given. Look here, the present value of annual lease payments is 650,000. Okay, the remaining useful life of the machine is much greater than the lease term. Okay, that part for now you just simply ignore. Okay, that part for now you simply ignore. So this is your question. Okay, they have given you the fair value, they have given you the carrying value, they have given you 4 years lease period, and also they have given you the present value of your annual lease payment, right? So most of y'all might be thinking, then why did they give this 200,000, 9%, 4 years? Well, if you all also redo the calculation, you all will arrive at a figure of 650,000. Now it's all about doing our double entries. It's all about doing our double entries, right? Similar to our very first question, we break the transaction into two components. One is your sale and the other one is your leaseback, right? I sold the asset. Sorry, just give me a minute. Let me zoom in. Yeah. So I sold the asset to a third party for 1 million, right? For 1 million. Sorry, my bad. This has to be bank. This has to be bank. I sold the asset for 1 million and I received cash of 1 million, right? And also what happened was when I sold this asset of office equipment, right? I need to de-recognize this asset. I need to de-recognize this asset. So I'll be removing it from my statement of financial position. How much was my assets value? How much was my assets carrying value? Is 800,000. Okay. So 1 million, I sold the asset. The asset at the date of sale was 800,000. Okay. One of the common mistakes that we make is under profit or loss, right? Under profit or loss, what we'll do is carrying value minus the fair value. We'll think 200,000 is the profit, which is wrong in terms of sale and leaseback. Why? We need to follow the balancing figure, right? So for now, let us leave the balancing figure as, or let us leave this profit line item empty and let us work on. Okay. Then number two, second instance is what we're planning on doing is we did the sale and now we're planning on leasing it back, right? We don't know ROU, right? We have to calculate ROU, but we know the lease liability. Lease liability, the present value of annual lease payment is 650,000. So debit ROU, credit lease liability of 650,000, right? Now let us go to ROE workings. Let us go to ROE workings. For that, we need to again refer this. We need to again refer this. Okay. So here it is. I have given you the ROE workings here, sir. Okay. 650,000 is my present value of lease payments, 650,000, and my total rights or the fair value is 1 million. So let me put off my calculator. That is 650,000 divided by 1 million. I am retaining 0.65 or 65% of the rights, right? I am retaining 65% of the rights into the carrying value, which is 800,000. Now, all these details are given on the question itself, right? And we will come up with a value of 520,000 for ROU, right of use of asset. Okay. Now, again, let me repeat what is ROU. See, what ROU or rights of percentage of rights retained is simple. It's quite simple. See, in the previous question, again, I'm highlighting the previous question because in this particular question, I want you all to tell me how it happens. Okay. In the previous question, what happened was we sold off the asset, right? When I sold off the asset, I got 100,000 worth of cash, right? But I am retaining only 60,000. How am I retaining? Because I am paying lease payments. I am paying lease payments or rental payments and retaining that asset back, right? That is why I call it percentage of rights retained. And this part is used to calculate right of use of asset, right? The same thing only happens for this also. The same thing only happens for this also. See, I sold this asset. I sold this asset for 1 million, right? And I received the cash of 1 million. But what am I doing? I'm leasing it back, right? Leasing it back means I am paying 650,000 as lease payments each and every year for the next 4 years, right? I'm paying lease payments for the next 4 years and using that asset, right? So I am retaining, I am getting back or grabbing back the right to use that particular asset, right? Which was 65% according to our calculations, which was 65%, right? So our ROU is 520,000, which is debit and credit lease liability, 650,000. Okay, now we are not done. We are not done. I told you, right? Sometimes they can test under MCQs. So one of the MCQ question is simply test ROU, or the most famous one is they'll tell you to find out whether it's a profit or loss. Never ever forget, never ever forget to use the balancing figure to find out your profit or loss. Okay. So we know that the debit entry, there are two entries, which is your bank and which is your ROU, right? Which is 1,000,000 and 520,000. So that is equivalent to 1.520 million. And on the credit side, there is 800,000 from your derecognition of asset, and also there's a lease liability of 650. So 8 plus 6 is 14, 1.450 million. Now you all can see your debit side is overstated and your credit side is understated. Now on your trial balance, you all know that you all need to be, both the debits and the credits has to be equal, right? So you need to add 70,000 to your credit. You need to add 70,000 to your credit. And since it's a credit entry, it would fall under profit. It would fall under profit. So this is it in terms of sale and leaseback. Don't worry, I'll be uploading another video or another debrief recording on questions related to BPP, Kaplan, and Study Hub, right? So thanks for watching it, and hopefully we meet in a very next video. Okay, that's all.